Tomorrow, July 3rd, we'll be getting the job report. We're looking for 110,000 jobs who have been created in June. We're looking for the unemployment rate to rise to 4.3%, average hourly earnings to rise by 0.3%, down from 0.4, year over year 3.9% flat. So we're looking for a weaker number. Obviously, we have to watch for revisions. We know that the job report is subject to revisions. We did get the ADP number today. That was weaker than expected by quite a bit. We came in at a negative 33,000. We were looking for positive 95,000. Last month was also revised lower to 29,000. And so surprisingly or not, the equity market was higher today, largely brushing this data off. I think from a perspective of the market, until it actually sees the whites of the eyes of an economic slowdown, it seems like it's not going to pay attention to anything at this point, because honestly, we've been fooled at this point by the data numerous times over the last 2.5 to 3 years, where the soft data looked bad and then everyone's expecting a slowdown and recession, only for it to never come. And really, until we start really getting some hard evidence from the official data sets that actually count, the market's likely going to continue to do that. Now, obviously, tomorrow, like I said, is the day that we're going to get this data, and but when you look at some of that data specifically, what I have here is a couple of different charts that I wanted to run through that shows that there has been further weakening in the labor market in the month of May and June. And so ADP number, which came in at that negative 33,000, and we had this Paychex small business employment indicator, which was also down. This is an index, so it's measured differently, but that was also down and actually at its lowest point now, going back some time. So really what we're seeing here is a slowdown in not just one measure of employment, ADP, but Paychex, which is another payment processor as well. And so those are two indications that suggest there was a slowdown in hiring in the month of June. When you look at the NFIB numbers, which is NFIB actual changes in employment, and versus the ISM manufacturing employment index, both were down pretty sharply in the month of June as well. So there's evidence to support this idea that we're going to get a weak job number tomorrow. Obviously, the problem is that the BLS, the way they calculate the numbers, doesn't always go with what we're seeing in some of these other surveys. And so you have to really be mindful that there's a chance that tomorrow's number could actually be significantly better than expected, and just likely it could be really bad as well. I think it's very much a coin toss in terms of how that is going to work out. When you look at Kalshi, which is the online prediction market, it's forecasting 110,000 jobs also, which is basically in line with what the estimates are. The Kalshi numbers I find to be pretty reasonable in terms of what the numbers come in to actually be. It's done a pretty good job in the past, especially when it comes to predicting the unemployment rate. And right now, the unemployment rate is expected to also be 4.3%. So if numbers come in as Kalshi is sort of estimating, we're going to probably get numbers that are in line to what the expectations are by analysts. But again, I think what's very clear, though, when you look at this data, is that there's a clear slowdown in the hiring trend. And I think that that's something that is pretty obvious. And how weak the number is tomorrow is really anyone's guess. I think it would be a shockingly big surprise if the number came in strong tomorrow. I think most expectations are for it to be fairly weak. And obviously, when you look at the shape of the yield curve and kind of how it's positioned at this point, I mean, we've been hovering around this 50 basis point region, call it really since April. Beginning of April. And really during that time, if you notice, the stock market's done fairly well, partially because you've seen the yield curve basically just moving sideways. My guess would be is that if you started to see the yield curve steepening again, you would start seeing the equity market struggle a little bit more. And the reason why I say that is because historically, when we look at the yield curve and we look at the steepening of it, you can see that when we started to steepen in this period of time, things got turbulent in July of 24. We had a really big steepening also into the year end, into the beginning of this year. Yield market came down. Then obviously we had the big steepening going into Liberation Day, and we also had a lot of volatility in the market. So, I mean, the trend seems to be that when the yield curve, here's another episode where we saw a really big period of steepening and the equity market really struggled. So my guess would be is that if we were to see this yield curve break out, it would likely result in another period of turbulence. It doesn't necessarily mean it happens right away, but what this kind of is showing us is that when the yield curve is steepening, generally speaking, you tend to see the equity market struggle. In fact, when you go back and you just look at it over a more historical point of view, what you see is that, typically when you start seeing yield curve steepening, like in here, for example, you had a pretty big, equity market drawdown, call it from around 365 on the S&P to around 300, which is more than a 20% decline. And then, of course, you had, the steepening of the 2000s, the steepenings of 2008. We didn't really get very much of an effect on the steepening on this side of it because we had all that monetary policy and all that stimulus that came following COVID. Plus, it wasn't really exactly a normal period of time. And so right now you've seen basically the equity market steepening, but you haven't really seen much of a sell-off yet. And so we'll have to kind of just keep an eye on it. But typically, when, at least even in this cycle, when you have seen big periods of steepening, you have seen the equity market struggle. So the reason why obviously we care about what the yield curve does is because really the yield curve just follows the unemployment rate. And, if you're going to see the unemployment rate rising, then you're going to start to see the yield curve steepening. It's just pretty much how it goes. And so this is because the market begins to anticipate a Fed rate cutting cycle. And my expectation would then be to see the yield curve steepen, and probably steepen in a fairly material way. We started talking about this a little bit over the weekend. So the unemployment number obviously will be an important number tomorrow. I think when you look at it, the unemployment rate will be important. The headline number will be important. And also keep in mind that we're getting initial jobless claims tomorrow. We're looking for 240,000, and you'll want to pay attention to the continuing claims number because that number has been rising as well. And this number tends to lead the unemployment rate. It just happens to be that we're getting an unemployment number on the same exact day we're getting continuing claims. So I would just pay attention to all of these things. I think they're all equally important. And so, again, generally speaking, when you look at most of the data, it's all kind of signaling this idea of a slowing employment trend. And then, of course, we can look at one more unemployment statistic. If you look at this one here, this is we have the unemployment number versus the jobs hard to get minus jobs plentiful to get rising. That also tends to lead to a steepening of the unemployment rate going higher. So there's lots of evidence to support that there's been significant slowing in the labor market and non-farm payroll. And there's lots of evidence to support this idea that you could really see the unemployment rate begin to move higher again. And so this is just what we're waiting to find out. And, largely speaking, the equity market today really didn't skip much of a beat. I think what's so important here is if you look at the VIX, it closed the day at like 16.3, 16.6, not very big move. And when you look at the VIX one day, that was actually up to 16 as well. So again, not as high as it could have been. Typically, this number is somewhere closer to 20. So it's not a very big jump. But again, what this is kind of indicating to me is that the market's sort of complacent around this number coming in tomorrow. So I would pay attention to it. I think it's a big deal. And, if you look at where the yield curve is, I mean, if you were looking at this chart pattern and you were looking to buy or sell this, I think you'd look at this and probably say that looks like a bull flag to me. And you probably would think that maybe this number is going to go higher. And my guess would be is that if it starts going higher, you could see it extend by about 40 to 50 basis points, probably to around 90 basis points before that's all said and done. Anyway, that's all I'm going to have for you. Have a good Thursday, and we'll see you again over the weekend. Bye.